Hi, this is Randy Finney, and today is Thursday, July 13th, 2017, and I wanted to do a quick market wrap on the U.S. equity markets. Nothing major today, slightly upward bias day, so we'll go over just one chart here on the Qs at least, and that's the 60-minute time frame. That's most of what I'm focused on now. Figured I'd do the video because there's a few other things I can point out here that are a lot easier done in video format than putting up a static chart, which I'll also accompany this video with. But here's where we're at. The Qs closed today at 141.02, and if you recall, going back from last week, let me pull up the post. This was a chart posted last week on July 11th, showing that alternative scenario to push up to that 141 level. That's a pretty significant resistance level. Still keeps the downtrend intact, although there has been, as I mentioned, some chipping away at the bearish case, no doubt, as we've taken out each of these previous reaction highs. However, the primary trend is still lower at this point. Let me clarify, not the primary trend. The primary bull market trend is well intact. I'm talking when we look at the very near-term downtrend. Now it's been 1 week. We bottomed here a week ago. This was Thursday, so we've been moving up for a week now. And last week, that was my preferred scenario, was to see us fail here at this 130 EMA. But I was watching to see what would happen, and we took it out. We stalled there for a little bit and then continued on up. So either way, that's where we are. Fast forward. Alternative scenario. Yesterday I posted that alternative scenario was taken out. Came into play as my primary scenario when the primary was taken out. So there we are, as of yesterday, looking for that move up to 141 and a reversal. We haven't gotten the reversal yet, but interestingly enough, we did close right there. Look at the close today, 141.02. You can see that the Qs stalled all day. They tried several attempts on 60-minute basis to print a solid close above there, but couldn't do it. So, one of the biggest periods of consolidation that we've had in a while. We've just traded around. These are all 60-minute candles right on, dancing around that 141 area. So we'll see what happens. What else stands out on this chart to me? First and foremost, I've been watching the PPO. It works a lot like the MACD, and I can see a pending cross. You can see the lines touching now. Looked like we might have had a cross there back at that point, and that's one reason I was looking out for a reversal there. You could see the PPO was turning down, but it failed to cross over the signal line, which is the 9 EMA. So when you have the blue line crossover, that white line, that's a bearish crossover. You can put up a histogram. A histogram will show the crosses. I don't have that up here, but you can easily see visually. So now what's the significance in that? Well, the PPO, just like the MACD, they're trend indicators, and it's showing you the current trend. So this is showing that the trend is waning right now. And if you go back in time, let's look at the crosses. We have the blue line above. It looked like it was going to cross, but it didn't. It bounced off the signal line, bounced, and finally had a cross right here. What happened? Well, that was the top and got you into this big move down. So again, any trend indicators I talked about in the video yesterday is commensurate to the time frame that you're using it on. So this is a 60-minute chart. These, PPO crossovers, although, as I always say, they're not standalone buy and sell signals, but when used in conjunction with other things, such as, for example, the fact we are at a significant resistance level now, we are overbought. That's something else I'm going to talk on here in a second. You add in all those factors and you're building the case for reversal. So, I'll say it outright. I think tomorrow will be a down day. Here is a previous bearish crossover. And I like to get away from times where it's whippy or we've already had a correction. So when we've been in an uptrend, that's when you want to look for bearish crossovers. Just as when you've been in a downtrend, you want to look for bullish crossovers, like we had a bullish crossover right here. So this bearish crossover right there marked the top and, signaled this first wave down. Then you had a bearish crossover there and it signaled that wave down. So we could very well get, a significant pullback here, especially with a high level PPO cross. By high level, I mean the PPO is up at the highest end of its range, at least going back for a few months here on this 60-minute chart. Okay, so those are the bearish things I'm looking at so far. We've stalled at resistance, a level where I expected if we got there, we would stall or reverse. We'll see what tomorrow brings. We also have that PPO bearish cross that helps to strengthen the bearish case. Okay, and finally, one other thing to cover here on this 60-minute time frame, and that would be the RSI readings. I've found over the years, and I've talked about this on the site quite a bit over the years. Something that I've noticed is that during a trend, and now this again it works on any time frame. I don't care if you're talking a weekly chart going back 10, 15 years or more, a daily time period. If you put up the RSI using what's typically the default setting, RSI 14, you'll notice that during a uptrend, overbought readings are not sell signals, because overbought can stay, and usually does stay overbought, for an extended period of time. So here's an example during this powerful trend, this leg up, at least again relative to the time frame that we're talking about, we had extended overbought readings. Right here we had a brief oversold, just one tag of the 30 level, which is oversold on the RSI, and the trend was still up until this point right here. Obviously when we topped, that's not rocket science, there's an uptrend, and we had a brief tag of oversold right here. And my point is that during an uptrend, oversold readings, standalone oversold readings, are usually pretty good buy signals because they're very fleeting. If you tag that 30 level or you get below it, that's usually it. You usually only get one tag, and then boom, the uptrend continues. And on the upside, when you're on an uptrend, as I said, the overbought readings are far from sell signals. They tend to stay overbought for a period of time. Okay, so that's that. Now flip it around the other way. We've been in a downtrend since the market peaked back on June 6th, right here. And as you'll often notice, and again, doesn't work on every single stock or securities, but look at the major indices, look at commodities, gold, things like that, or a certain stock that you trade, and you'll notice this. Now during the downtrend, we became oversold. We almost hit the level there again. We had a little divergence right there. Came back down to that oversold level. But here when we became overbought, it was very fleeting. We had one tag of that 70 level, and then boom, we came all the way back down and remained oversold for some period of time. Point being, we look at this reading, we just recently crossed above the 70 level, and if we do get a reversal here, we'll get back down below there, and my expectation is that we will not stay overbought. If we get a little blip, a little pullback, maybe let's say here's one scenario for the bulls, we backfill this gap right here, you can see the gap, or even come to the top of the gap. Most gaps are backfilled, so if you're bullish, you'd probably want to see that gap backfilled just to get that over with, and then a resumption of the uptrend. And that's going to, of course, be bullish. It's going to take out my 141 resistance level. It'll take out this previous reaction high, and that opens the door to new highs. So there's your bullish scenario. And that would also keep this, you'll probably have see the RSI become overbought once again soon, and you might not even get down to the oversold level. And if you do, again, if you're bullish, that's a check mark for you. When you see on the 60-minute time frame oversold, you're not going to see it on the daily time frame during a strong uptrend. But that's what I'm looking for. So those three things: market at resistance, bearish PPO crossover, and I'm sure the MACD will probably look similar, if not the same. And then that overbought reading, which again, this all hinges on my outlook that if this is just a counter trend bounce, then we hit the high end of where I thought it would go, and now it's probably going to be over. And we'll know probably by tomorrow. If we don't see a reversal here and we punch on through there, we stay overbought, that's changing the dynamics of things. It's changing the dynamics of this downtrend, and really, it's already been called into question somewhat, but it hasn't been put to bed yet. So that's that. Okay, that's all near-term stuff, and that's what we're watching for, or what I'll be watching for the next day or two here. Tomorrow we head in last trading day of the week, and then we'll see what happens next week. Longer-term stuff, the longer-term, all the Okay, sorry I had to pause the video for an interruption there. Let's see, what I was saying is long-term. I was looking, every now and then I'll go back to what I think are similar points in the market. And so what I did is I took a look at the market here. Let me show you what I did here. I went back and looked at the market over the last few years. Here's a clean chart of the Qs going back to 2013. And so let's take a look at this top, because I've highlighted for months now the same bearish technicals that we've seen, deterioration in market breadth, fewer and fewer stocks advancing and lifting the markets, everything that I've covered in the past. So the biggest correction that we've had by far in the markets came right here. The Qs had a mini flash. If you want to count that mini flash, and it did happen, those are prints, they would have undone it in the charts if it didn't happen. So people were executed there. Otherwise, they erased that candle. But as you guys remember, it snapped back that day and closed up here. So either way, even where we closed the day and then hit the next day, that was about a 14% drop. So the healthiest correction by far in the market, in the ongoing bull market. And then we were followed up with another one there. So what I did is I put the crosshairs here. That's July 21st right there when we peaked. And so I just went onto the site. You can get the archives. They're up in the right-hand corner. You go to the top of the site. There's a little plus sign. Pull that down. It'll pull a drop-down bar, and there's a calendar there. And so I went back to July 21st. So let's see what was, what I was saying. And here's some of the charts. Here's a post warning of a, substantial correction, and here are the reasons why. First was the spread on high yield bonds. I didn't pull that chart up right now. I can tell you they have been ticking up. I've looked at high yield spreads. They have been starting to move up, and more importantly, diverging. It's normal to see high yield credit spreads go up during a decline in the stock market, but when the stocks are rising and you see credit spreads also rising, that's abnormal, and that warned of a correction back then. So let's just get into these two right here. The S&P 500 percent of stocks trading above their 200-day moving average, which is the green line below, and the S&P 500. And back at that time, you could see the clear divergence. See the S&P 500 going up, had a little blip here. It did have a little correction, a little pullback, but that divergence then it extended. We had a second consecutive divergence with a slightly less steep uptrend line, but you can see that the percent of stocks, even as the market was continuing higher, really dropped off. The percent of stocks trading above their 200-day moving average, and that to me was a red flag for a correction. Same thing I was pointed out on, again, this is July 21st. All my charts are time stamped and date stamped. You can see the little corrections along the way, all the divergent tops between, again, in this case, the percent of Nasdaq stocks trading above their 200-day moving average and the Nasdaq itself. So that was a precursor to that big 20, anywhere, call it, it was what it was, a 20-something% drop from top to bottom. And now fast forward to today, and here's the same charts. I have a different color on this. Change the colors around, but same thing. So there's 2015. You see this dotted line right here? That's that chart we were just looking at. And there's the big correction that ensued following those divergences. And fast forward to today, we're seeing the largest correction other than those. That previous drop. And this was, again, a series. It had other corrections within there. So each of the divergences did play out. But finally, as they were consecutive, 2 or 3 consecutive divergent highs between the market and the percentage of stocks making or trading above their 200-day moving average, it finally just, the market cratered at that point, had a very sharp correction. And now this divergence is very steep. In fact, the divergence itself is a little more steep, in other words, more pronounced. You can see a very, very steep, even a much steeper advance than we had here in the Nasdaq composite. And you can see a clear decline or downtrend line in the percent of stocks trading above their 200-day moving average within the Nasdaq. So that's where we are. Do we get a little blip? Even if this is just a little blip here, it's going to be one of these blips is what I believe, not what we've had so far. What we've had so far, even though it started out with a bang, has been, let's just say, not commensurate or in line with the divergences that I'm looking at here. So maybe another leg down, another thrust up to put in another second consecutive divergent high. I don't know. All I'm saying is this is a red flag. And the other one here, same thing, S&P 500 relative to the NASDAQ 100 or NASDAQ composite has held up recently. However, you see the same divergences. Here's, again, this is a chart going back. There's that top back in 2015, mid-2015, big correction, the S&P 500. Here we are today. This is the percent of stocks trading above their 200-day moving average. We saw a sharp advance in the S&P 500 after the elections. That's that Trump pump. And, stocks did participate. We had a healthy advance, so it was almost flatline divergence. You had almost an equal high, but that's still divergence. But more importantly, we had a little blip and then another thrust up. During that thrust up, there was a noticeable drop-off or divergence between the two. So that, again, this is far from a timing indicator, but it is something that says, hey, everything's not well under the hood. This is fewer and fewer stocks doing the heavy lifting in the market, just as it was back in 2015. So that's longer term stuff. Let's just focus right now on these 60-minute charts and go from there. We'll see what happens tomorrow. Again, as I said, with each tick up and as each of these previous reaction highs are taken out, we get close to that, that's going to act like a magnet. The previous highs will act like a magnet in QQQ, but we're not there yet. A lot of corrections begin with an initial leg down and then a counter trend rally that convinces the masses by the time that it's done. Most who were bearish or tried to short that have given up, thrown in the towel, saying the market will never go down. And those that are bullish are seeing what they want to see, thinking that the market will continue up. We'll just have to take it from here. But that's what I'm watching for, guys. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.